Welcome to Early Age Club, where we break down one microcap or SME stock a day using a simple structured 20 factor scorecard. Microcap investing can be rewarding, but it's also full of traps. Our goal with this series is to help every retail investor avoid the common mistakes and develop a more thoughtful approach when it comes to investing. If you're new here, I recommend checking out the explainer video on how to use the scorecard. Try scoring the company yourself as it will give you real hands-on clarity. Today's section is divided into understanding first the business model, the industry, and then we use our 20 factor scoring, and finally our take on valuations and risk. This company analysis and discussion are part of our internal conversation as we review companies from our ongoing 500 plus microcaps and small cap stocks. We are sharing this to retail investors can build a structured framework when it comes to microcap investing. Just to be clear, this is not an investment advice. Our goal is to help you invest smarter and safer and not tell you what to buy.
Today's company is Chatha Foods Limited, and it was established in 1999. It is one of the leading frozen food processors in India, catering to the top QSRs, casual dining restaurants, in the Horeca segment. So it has a manufacturing facility in Mohali. They are building another facility nearby to it, and they have a pan-India distributor network. So they offer various products, including non-vegetarian, vegetarian, and plant-based food. You can see in the image the type of products they offer under their non-vegetarian, plant-based, and vegetarians. So these are some of the products which they offer. So if you can see, these are the metrics from FY25's report, basically investor presentation. So if right now they are doing 100% of their sales from India only, but they have plans to export. And if you see right now, non-vegetarian foods form maximum part of their revenue, and vegetarian is just 2.8%. They are trying to expand it through a facility, which we will see later. And if you see revenue by customer, so in FY25, Domino's is the biggest partner or client which they have, and 46% of their revenue comes from Domino's only. Rest 21% comes from Subway, 9% comes from Wok Chinese, and 22% comes from other QSRs, which are small, or some. There are some big chains also, but a lot of QSRs which they are supplying to are very small. So moving forward, so as you can see, these are some of their clients. In QSRs, they have Domino's, IHOP, Jubilant Foodworks, Subway, Burger King, Chinese Wok, Taco Bell. They are one of the biggest suppliers to Taco Bell. Casual dining restaurants, Cafe Coffee Day, Third Wave, etc. And apart from that, there are other segments which they cater to, such as Hyper Pure, which is a venture by Zomato, and other such brands. So this is some of their customers. Moving forward, so as you can see, the leadership team and the board of management, both of them, they have good experience in the industry, especially the two brothers, Paramjit Singh Chadha and Gurpreet Chadha, both have good experience in this industry, and they have been doing this work for more than 20 years. And independent directors also have good experience. So overall, a good management team. Let's move forward to let's see the industry overview. So as you can see, this is the QSR market in India. This metric was taken from a company's RHP. So as you can see, from FY23 to FY27, QSR market in India is poised to grow at more than 20% CAGR. So one of the major growth drivers for this industry is, of course, the increase in population and increase in per capita income of our country. So the GDP growth, consumers are spending towards QSR and other restaurants. So due to which are also growing, and because we are catering to them only, ultimately our business can grow. So as you can see, another metrics, Burger King, Wendy's, Popeyes, KFC's, Jumbo King, etc. all have their all are about to open a lot of stores in the coming years. So which are one of the growth drivers for our company also, because we are ultimately supplying to them only. So section one, governance and promoter behavior. So IPO, if we see, they had raised 34 crores in March 2024, which was used mainly for capex. A director and promoter track record. The directors have maximum shareholding and there is no bad remarks about them. So 5 on 5 score again. Related party transaction, 5 on 5 score. There were no related party transaction. Board composition, if we see, six directors are there, out of which three are independent, two are family on board. So again, a 5 on 5 score. Salaries and remuneration, if we see, both MD and chairman and whole-time director salaries are beyond our limits. So 5 on 5 score again. Moving forward, key person resignation. So there were two resignation. Chairman and executive non-executive director had resigned in Jan 2024, and a company secretary had resigned in September 2023. Auditor resignation, 5 on 5 score, as there was no auditor who had resigned or there was no auditor change. Auditor opinion has been unmodified, so 5 on 5 score again. There were no regulatory or legal issues, so 5 on 5 score again. Investor communication, if we see, PPTs were there for only 2 quarters they had provided. Apart from that, PPTs were not there. So for now, I gave three. Con calls were there, and result and quarterly and half yearly results were also there. So due to that reason, I gave 3 on 5. Moving forward to our section 2, financial health. So there is a business concentration risk. Right now, if we see from FY21 to FY23, the top 5 and top 10 customers or clients made almost all of their revenues. Right now, also in FY25, Domino's is a large, so due to that, because it is a very concentrated business. If Domino's or other major clients decide to change their suppliers or vendor strategy, then it can affect our business. Moving forward to revenue growth and receivables. So although it has remained below our metric, but this year it grew a lot. I mean 102%. And there were no major reason mentioned because actually the con calls which they do are with they don't have any analyst covering them, but they have institutional clients. So I read the con calls, majorly all the con calls, majorly everything similar in nature was discussed. So I gave 3 on 5 right now. Moving forward to operating cash flow by EBITDA, because this year it went into negative, I gave 3 on 5. Apart from that, previous 3 years and before that also it has been good. Right now it has increased majorly due to that they are doing capex heavily. So that is one reason due to which it went into negative. Inventory trends, if we see, it is good. So I gave a 5 on 5. Cash conversion cycle is also good. So I gave 5 on 5 on that too. Moving forward, capex by revenue was fine. So I gave a 5 on 5 score. Debt and liquidity position both were so ROC and ROE. So ROC and ROE has been low consistently for over the last 5 years. So due to that reason, I gave 3 on 5 for now. I think it will increase in the coming times as they supply more and they are doing capex also. They are starting exports also. I think it will increase. But for now, it is low. So due to that reason, I gave 3 on 5 score. And growth consistency, revenue growth is fine, but it is low, but it is fine as of now. It is consistent, but PAT margin is very low as of now. Moving forward to bull case, why this might be exciting. So there are, first of all, there is big growth coming through new plants. They are building two new production units. One is for vegetarian foods like gravies, parathas, tortillas, etc. They are focusing with the joint venture with Alana. It will focus more into exports of processed meat. So once both of these are live, their total production capacity will grow from 6,000 tons to 28,000 tons per year. So it is nearly 5x compared to now. So moving forward, so what they are doing is the export, what do I say? Export relation with Alana, joint venture with Alana. What they are doing, they are investing 12 crores or 13 crores, and rest is invested by Alana. So Chatha will do all the production. So this is what their plan is right now. Yeah. So there is a strong client base with a sticky relation with their clients. So if you see, they have been supplying to Subway for over 20 years and over a decade, and they recently added names like Tim Hortons and Burger Singh. So their products are often customized for each QSR, which makes switching to new supplier a bit difficult. A bit difficult because it is not very difficult because big companies like Domino's, they have multiple vendors. So but because we are doing customized products for some of the brands, so it is becoming a bit difficult to switch to a new supplier. As I mentioned, the capacity expansion of 6,000 metric tons per annum to 28,000 metric tons per annum. So they are expecting it by FY28. So this is what they are expecting. And moving forward to currently they have a gross margin of 27 to 28%. By FY28, they are expecting a blended gross margin of around 30%. What they are saying is they want to avoid any D2C brand investment because, as I said, they have done it previously and it did not work properly and they had to shut down all their operations from B2C. So, right now they are focusing only on B2B. So, this is what they are focusing on. And there are some industry tailwinds. So, what they are doing is some of the industry tailwinds are the QSR chains are outsourcing their kitchen complexity. So they are outsourcing the products, and our company gives gravies, frozen premixes, and non-vegetarian. All the meats we are doing right now, but these are also something which we have started. So this will help the company in growing more. Yeah, the company, I think they are expecting 400 crores of revenue to reach 400 crores of revenue by FY28. So this is some of the things which were mentioned in the con call. So moving forward to bear case. So execution risk is there. So basically, both the vegetarian plant and the Alana joint venture are under construction. So any delays in commissioning or in getting client approvals can push the revenue further out. And second, there is financial strain is starting to show them because the receivables have increased because newer clients are taking longer to pay. Their total debt could go from 21 crores right now to 30, and that means the interest cost will also increase from them, and which will put pressure on our profits. Third is client concentration risk. So we have a heavy dependence on clients. As I mentioned, right now in the top three clients contribute 65 to 70% of our revenue, and in that Domino's is the major, as we saw. So as I said, any shift in their sourcing strategy will be a threat to our company because there is no exclusivity in our business. A lot of QSRs follow multi-vendor strategy. So if this becomes price driven, then also it will be a very big risk. And last, it is regulatory roadblock. So some of the roadblocks, if I say that they can't sell pork because of their halal demands, they avoided fish because it needs separate facility, and the exports of chicken aren't allowed, which limits growth in their original core category. So these are some of the bad cases with the company. So as we can see, as per our overall model, the final score comes out to be 83, which is very good.
Before we deep dive, quick note, we are opening Early Edge Club to a small founding cohort of 15 to 20 serious microcap investors. We are building a research first community where we break down businesses together. Every month, we deep dive into two microcap stock chosen by the community. You will be surrounded by thoughtful, like-minded investors from diverse backgrounds, and we are keeping this group small intentionally to preserve the quality of discussion and make a real personal connection. If that sounds like the kind you want to be part of, fill out the short form linked in the description and we will reach out to you soon. Let's quickly look into the
Look forward
valuation,
to
but
it.
promoter wise, they are
Yeah.
good segment which is more health conscious, right? Like plant based. So
Yes.
that is
Plant
extremely,
based.
and that could open up their export opportunity as well. So
Yes.
the current
Yes.
market cap is 252 crores. I think promoter has tried different things
Mm.
and now they have better understanding of the market. So they are well positioned to
Yes.
navigate the challenges now. PE of 41 is high, but I believe it is because of the pressures. So it is bit inflated. If margin normalizes, then the PE would drop down. Uh, so let's current price at 105. That for it's giving a price target of 199 and 191 best case, but I would go with 178 to be conservative.
Mm.
And yeah, 6.6 is a margin that looks most likely. and based on that and 35
Mm.
PE, it is trading at hundreds. On the worst case, it is fully
Yeah.
reflected in the price, so which is good in a way. So let's see
Mm.
how it pans out. As you said, the borrowings have increased. So that is something we need to see how the management manages that going forward. And but then the good thing is they have done good capex,
Mm.
and the capex phase is done.
Yeah.
Though cash conversion cycle has increased, it's still good compared to many
Good.
companies
Good.
out there. Did they
Mm.
raise capital of late? I think they raised.
I think they raised preferential issue to fund this
Yeah,
joint venture with Alana and do
yeah.
and
Sweetie
some
capital has
capex
gone
also.
up, so
Yeah.
they have raised capital as well. So
Yeah.
basis PBT, I would still keep 9 crores.
Mm.
So this earnings is again very subjective, and as an microcap investor, your
Mm.
risk appetite is the return minimum you require is around 20 for the risk you're taking, um, and terminal growth rate of 3. And if you have at least a 5 year horizon and like a 15 PE at the end of the period, the company has to grow at 28% year on year.
Mm.
So reasonably priced, so maybe a bit of correction we could start accumulating, but
Yeah.
definitely a company to watch out for and keep track of.
Yeah. And technically, I think they have formed the prices formed a
Our
base
100
technical wise.
as 88 to
Yeah.
100, it is forming a base. So
Yeah.
a correction to words, but would
Mm.
it go there or not? No idea.
The joint venture with Alana, what they have done is completely export focused. The capex they are doing with them is not going to help in domestic sales. So it is completely going towards exports. That will increase their revenue more, I think, because the margins will be good.
mm, mm. Yeah, those few we need to understand the pricing because as you saw, out of content speaks with some on the leaders is something we need to look into it. And also there are other established players like Venky's India. They have the poultry unit, so we need to see how it is done, the whole supply chain, etc. But that will be in the second phase of
Mhm.
it. But good, interesting business overall. I hope you found this framework useful. If you follow this company or have any interesting insight, we would love to hear from you. Drop a comment below. If you have scored this company using our 20 factor scorecard, feel free to share your score and how it compares with ours. If you found this useful, consider subscribing and also check out other videos where we break down more microcap companies and SME companies. If you are interested in joining our small research first cohort, the link to apply is in the description below. Thank you for watching, and we will see you in the next one. Bye bye.